Imagine you're sitting across from John Bogle, founder of Vanguard, in his modest office on a quiet April afternoon in 2007. He's flipping through decades of stock market data, quietly confident. While the world buzzes over hot stock tips and flashy fund managers, Bogle's message is simple and stubbornly revolutionary. Just buy the whole market cheaply. But why would anyone bet on average returns instead of chasing the next big win? Let's crack that mystery wide open. People love stories of soaring stock picks and genius managers. But Bogle flips the script, exposing why most get burned chasing outsized wins. Bogle tells the story of the 1990s tech boom when fund managers scrambled to pick winners like Microsoft and Intel. Yet, most fell short of simply buying the S&P 500. Even the best managers with years of experience and armies of analysts rarely beat the market consistently. The takeaway? Trying to handpick stocks or time the market is a losing game for almost everyone. Think of index funds as a glass window reflecting the city skyline. Instead of chasing one shimmering tower, you see the entire city's beauty at once, without distortion or guesses. An index fund simply owns a slice of all companies in a market, mirroring returns exactly and without personal biases or risky bets. Imagine a leaky bucket where every fund manager takes a small cut, and the cost of trading steals from your pot. Over 30 years, these fees might drain half or more of your investment's growth. Bogle reminds you that low-cost index funds keep your money intact, letting compound growth work its magic, rather than feeding costly fees to Wall Street middlemen. Bogle's secret weapon? Time. Waiting doesn't just help, it transforms your returns in ways chasing quick profits never will. Bogle recalls legendary investor Warren Buffett's advice. The stock market is a device for transferring money from impatient to patient people. Over decades, dividends reinvest and interest compounds on itself, like a snowball that starts small but swells into an avalanche. This slow-motion rocket fuels long-term wealth far better than quick flips or frantic trades. Remember the 2008 crash? Many panicked and sold low. Bogle highlights how those who stayed invested through crashes banked on recovery and growth instead of fear. It's like riding a roller coaster. You don't jump off mid-drop or you miss the thrilling climb. Staying put through the dips lets volatility work asterisk for asterisk you, not against. In the new chapters, Bogle emphasizes tailoring your asset allocation to your age and retirement goals using low-cost index funds. By adjusting the mix over time and avoiding costly churn, investors can build portfolios that steadily grow without frantic guesswork, making retirement less about luck and more about disciplined strategy. Bogle's radical idea: aim for your honest slice of the market pie, not the whole bakery. The trick: simplicity over complexity. Bogle breaks down market returns into three pillars: dividend yield, corporate earnings growth, and changes in market valuation. Think of it as baking a cake. Dividends are the oven's heat, earnings the ingredients, and valuation the frosting's sweetness. Trying to guess which slice will taste best misses the point. All pieces rise or fall together over time. He tells the story of how some investors chase hot sectors or trendy stocks, often exposing themselves to risky crashes. Instead, owning a broad slice with index funds spreads your eggs across hundreds or thousands of companies, seasons, and sectors, a strategy as wise as carrying an umbrella on a cloudy day. You won't stop the rain, but you won't get soaked either. Bogle challenges the endless swirl of investment advice, hype, and marketing tricks. He urges investors to tune them out and stick to what history proves: low-cost, broadly diversified index funds outperform most fancy strategies. Like tuning out static to hear a clear song, simplicity leads to clarity and better returns over decades. Remember that quiet office in 2007? Bogle's barebones message rings truer today. Forget flashy stock picks and complex moves. Buying the market cheaply, staying patient, and keeping things simple means you collect your fair share of growth without the stress or fees. Next time you check your portfolio, try this. Pick a low-cost index fund and hold it steady. Watch patience and simplicity work their magic. Subscribe for more book summaries like this one.